Every single time you type a prompt into a generative AI model, you probably picture code floating in some ethereal cloud.
Right, the magical cloud.
Yeah, exactly. But the reality is that data is being physically shot as lasers through, like, tiny glass tubes across the entire country.
Which is wild to think about.
It really is. And one historically boring telecom company essentially owns all that plumbing. It is Thursday, June 4, 2026, and while the whole world is obsessed with the sleek, flashy software side of the AI revolution, we are looking at the physical reality that makes it all possible.
Because we gravitate toward what we can see on our screens, right? But the infrastructure required to train and run these massive AI workloads is, well, it's anything but virtual.
Absolutely not.
Right. It requires vast amounts of raw materials, power, and highly specialized physical networking gear.
Okay, let's unpack this.
Yeah.
Because trying to understand the AI boom without understanding a company like Ciena, that's C-I-E-N, by the way, is like staring at a fleet of Formula One race cars, but completely ignoring the asphalt they actually drive on.
That's a great way to put it.
Right. Ciena builds the literal gear that moves data as light. And today, our mission for this deep dive is to look at their latest earnings call transcript and their financial summary. We really want to figure out how a cyclical telecom equipment vendor suddenly became this structural AI infrastructure platform.
And more importantly, if the numbers actually justify all this hype.
Exactly. Now, just a quick reminder for you listening, this deep dive is strictly for educational purposes. We aren't giving investment advice here. We are simply exploring the facts, the numbers, and the narratives moving the markets today.
You can't just pave this AI asphalt for free.
Definitely not.
Building out these literal light-speed networks takes billions of dollars, and that sudden urgency from the tech sector is dramatically altering Ciena's balance sheet. I mean, we're looking at a Q2 fiscal 2026 that was just an absolute blowout.
Yeah, blowout is the right word.
They posted record revenue of $1.57 billion. That is up 40% year over year.
40%. Wow.
Yeah, and they beat their own internal guidance by a massive $71 million.
The top line is huge, sure, but the profitability is what really caught my eye. The adjusted earnings per share, the EPS, hit $1.64.
Which is crazy for hardware.
It is. That's roughly 4 times what they earned a year ago, a 400% jump in a single year. And they're pulling in $219 million in free cash flow just for this quarter, which that basically pads out a $1.4 billion cash pile.
What's fascinating here is the sheer magnitude of the margin numbers in a hardware context. Hardware has this long-standing reputation for being a commoditized race to the bottom, right?
Right. Usually everyone just undercuts everyone else.
Exactly. But Ciena just posted their third straight quarterly gross margin raise, hitting 44.9%.
Nearly 45% margins on hardware.
Yeah, and when you dig into the operational mechanics behind that, management points to, well, engineering cost reductions, a highly favorable product mix, and a strategy they call value exchange pricing.
And that concept, the value exchange pricing, that's critical to understand.
Yeah.
Because they aren't using traditional cost-plus pricing.
Right. They aren't saying, it costs $10 to build, so we'll charge $12.
Exactly. Instead, they're looking at the hyperscalers, the massive cloud providers, and calculating exactly how much money this specific piece of equipment saves them in data center footprint and cooling costs.
It's brilliant, really.
It is. If Ciena's gear saves a cloud provider $50 in operational overhead, Ciena's pricing their equipment at $20 to capture a piece of that created value. It demonstrates just an incredible amount of pricing power.
Absolutely.
But, this brings up a glaring contradiction for me.
Yeah.
If earnings are up 4x, and they have this kind of massive leverage over the biggest tech companies in the world, why isn't Ciena a household name? Like, are we witnessing a permanent structural shift in how global networks are being built? Or is this just, I don't know, a momentary spike in demand?
Well, to figure out if this is structural or just a blip, we really have to isolate exactly where that $1.57 billion is coming from.
Right.
Because Ciena's legacy is in long-haul and metro optical networks. Basically the traditional telecom gear that connects cities together.
The boring stuff.
Right, the boring stuff. And that segment was strong. It was up 42%. But the explosive engine driving these numbers is their routing and switching business, which rocketed up 88%.
88%. And within that routing and switching division, their flagship platforms, the reconfigurable line system, or RLS, and Wave server, both of those jumped 55%.
Yeah, but the absolute star of the show, without a doubt, is DCOM.
DCOM, the data center optical module.
Yes, DCOM. And this is where we have to look at the actual physics of the AI boom. Think about what happens inside a massive AI data center. You have thousands of processors just churning through incredibly complex math, right?
Right.
Traditional network architecture relies on copper wires to connect these servers. But when you push AI-level bandwidth through copper...
It generates mass amounts of heat, right? The electrical resistance is just too high.
Exactly. The signal degrades rapidly over very short distances. You literally cannot push enough data through copper fast enough without melting the cables or just, losing the data packets entirely.
It literally becomes a hard limit governed by the laws of physics.
Yes. So the only workaround to handle the sheer velocity and bandwidth of AI workloads is photonics. You have to convert those electrical signals into light and send them over fiber optic cables.
And DCOM is the gear that actually sits in the data center, making that light speed transmission possible.
That's right.
And the companies buying this gear are the undisputed giants of the industry. Overall cloud revenue for Ciena was up 70%. 2 individual cloud customers now account for more than 10% of Ciena's total revenue each.
Which shows incredible concentration.
Huge concentration. These hyperscalers are building what are called scale-across networks, which are completely different from traditional internet architecture. They're designed specifically so thousands of processors can talk to each other simultaneously to train these AI models.
And we saw a milestone this quarter that really highlights the durability of this new architecture. Ciena secured its first ever multi-rail order for their RLS hyperrail platform from a leading hyperscaler.
Wait, first ever?
First ever! This is a brand new category of demand that literally did not exist in their pipeline a year ago.
That's incredible.
And management quantified this specific deal as being worth hundreds of millions of dollars over multiple years, with rollouts scheduled all the way through 2027.
Here's where it gets really interesting. Because when you have an anchor customer like Meta driving that DCOM growth, and you are signing hundreds of millions in new multi-year rollouts, your backlog starts to look, well, astronomical.
It piles up fast.
Ciena is currently sitting on a $7.7 billion backlog. But I have to play devil's advocate here for a second. We all remember the supply chain panic of the COVID era.
Absolutely. Right? The hoarding.
Exactly. Companies were double or triple ordering hardware, hoarding it in warehouses just to ensure they had inventory in case the supply chain completely froze. It created this massive illusion of demand that eventually just evaporated. So, how do we know this $7.7 billion figure isn't just the AI equivalent of hoarding toilet paper?
That is the exact question analysts were hammering on during the earnings call. They were incredibly aggressive, probing to see if this was just phantom demand.
Right, because if it's phantom demand, the whole thesis falls apart.
Exactly. But Ciena's chief financial officer, Mark Graf, had a very specific rebuttal. He stated this backlog gives them excellent visibility into 2027, explicitly denying that it is COVID-style stockpiling.
Did he give a breakdown?
He did. Graf broke the $7.7 billion down like this. $6.4 billion of it is strictly hardware, and roughly 80% of that hardware is scheduled to ship within the next 12 months.
Okay, so these aren't speculative orders meant to sit on a dusty warehouse shelf somewhere. They're tied to active, fully funded data center builds that are happening right now.
Right. The orders are immediately being deployed to keep pace with AI training schedules. And the customer base for this optical shift is broadening out too. I mean, Meta might be the anchor for DCOM, but management revealed that a second hyperscaler is now actively placing orders, and a third is deep in the qualification process to start buying.
So it's spreading across all the big players.
Yeah. Ciena projects DCOM alone to represent a $1 billion to $3 billion total addressable market by 2029. And overall, they expect their broader market opportunity to double to $50 billion in that time frame.
Okay, but if the demand is this insatiable and the backlog is sitting at nearly $8 billion, why stop at $1.57 billion in revenue for the quarter? Like, why not just run the factories 247 and clear that backlog out?
I'm sure they'd love to.
Right. But the answer comes down to the physical constraints of manufacturing high-end optical gear. Ciena CEO Gary Smith summed it up perfectly by saying they're operating in an environment of unprecedented demand and a constrained supply environment.
And that phrasing is critical. Demand isn't the problem here. Supply is gating demand. They are hitting severe bottlenecks on the raw components required to build these optical systems.
Because we're talking about highly specific, incredibly complex pieces of technology. The main choke points they mentioned are modems, digital signal processors, and pump lasers.
Yeah, let's talk about the DSPs.
A digital signal processor, or DSP, isn't just a generic computer chip, right? It's tasked with the insane math of converting digital ones and zeros into continuous analog light waves.
It's an incredibly heavy lift computationally.
And those pump lasers, they act as optical amplifiers. When light travels over long distances, the signal naturally fades. The pump lasers inject energy into the fiber optic line to boost the signal without ever converting it back to electricity.
And you can't just source these components from a generic factory overseas.
No, they require almost atomic-level precision to manufacture.
If we connect this to the bigger picture, these manufacturing complexities highlight the exact nature of Ciena's competitive moat. Analysts often describe Ciena's moat as narrow but real.
Narrow but real. I like that.
The real part stems from their dominance in what is called coherent optics technology.
Let's actually define that for you listening, because coherent optics sounds like standard marketing jargon, but it's actually a massive technological barrier to entry.
It really is.
When you shoot massive amounts of light down a glass tube, the light waves eventually start to blur together and overlap. It creates optical noise, which just ruins the data. Coherent optics act almost like a pair of high-end noise-canceling headphones, but for light beams.
That's a perfect analogy.
They use incredibly complex modulation to filter out the noise and distortion, allowing a pristine, massive beta stream to travel cleanly over really long distances. And Ciena essentially owns the proprietary magic that makes that happen.
Right. And that proprietary technology makes their gear mission-critical for the hyperscalers. You simply cannot run a scale across AI cluster without it. And once this level of core infrastructure is deployed, the switching costs are astronomical.
Yeah, I imagine.
A cloud provider cannot easily rip out their fundamental network plumbing just because a competitor offers a slightly cheaper box.
But, okay, if Ciena's making these massive 45% margins on this gear, doesn't that put a giant target on their back? I have to imagine other tech companies are looking at that profit pool and trying to build cheaper, off-the-shelf components just to cut Ciena out of the equation, which is probably why that moat is considered narrow.
That is the exact threat. The risk is that the value in optical networking could migrate away from Ciena's proprietary, fully integrated hardware systems and move toward merchant chips and pluggable optics.
Merchant chips meaning what exactly?
Standardized, off-the-shelf silicon that anyone can buy and build into a system. And pluggables are essentially commoditized optical transceivers that just pop in and out of generic switches. If the industry standards shift toward these cheaper, interchangeable parts, Ciena's margins will get crushed.
So they constantly have to out-innovate the commoditization of their own industry. It seems their primary defense against merchant chips is their co-creation strategy. They don't just build a box like the RLS Hyperrail and, hand a catalog to Meta or Microsoft.
Right, they don't just sell it out of a brochure.
Exactly. They sit down with the hyperscalers years in advance and co-create the roadmap, integrating their proprietary tech deeply into the specific architectural plans of the data center.
It creates a deeply symbiotic relationship. But even with that deep integration, the operational reality today is pretty brutal. They have flawless execution on the engineering side, paired with severe supply constraints on the manufacturing side.
It is like being the hottest, most exclusive restaurant in the city. You have a line of VIPs wrapping around the block, waving cash, begging to get a table. But back in the kitchen, you are literally running out of ingredients. Right. You can only serve meals as fast as the delivery truck can drop off the truffles and the Wagyu beef.
The bottleneck isn't the customer's appetite, it's the raw materials. And this dynamic creates an immense amount of tension when we pivot to look at how the stock market is actually pricing this company today.
Oh, the financial mechanics here are wild. As of this report, Ciena's stock is sitting at $492 a share. That means the company is trading at a staggering 87 times trailing earnings.
87 times?
That puts it at the absolute ceiling of its 5-year historical range.
Oh, yeah, an 87x multiple is the crux of the tension. Just a few years ago, Ciena was trading at around 16 times earnings. The leap from 16x to 87x didn't happen because they suddenly sold 5 times as much gear overnight.
Right.
It happened because of a massive narrative re-rating. Investors stopped looking at Ciena as a cyclical telecom vendor vulnerable to the boom and bust of carrier spending and started valuing it as a premier AI networking platform with structural, unstoppable growth.
But when you are priced for perfection, the expectations for future growth become astronomical. Looking at their forward guidance, management expects Q3 revenue to be around $1.625 billion, give or take $50 million. They also raised their full-year fiscal 2026 revenue guidance to $6.3 billion.
which represents a 32% increase.
Right.
Those are phenomenal numbers for hardware. But we must acknowledge the deceleration that is mechanically occurring. They just posted 40% growth this quarter. Moving forward, they are guiding for that growth rate to step down into the mid-30s. The pace of acceleration is actually slowing.
And any deceleration is a massive risk when your stock is priced at 87 times earnings. We already discussed the supply constraints actively capping their revenue potential. Then you have to factor in the extreme customer concentration.
Yeah, the two big clouds.
Exactly. When just 2 cloud providers make up a full third of your quarterly revenue, that's a serious double-edged sword. If either of those hyperscalers decides to delay a data center project, or worse, if they successfully start multi-sourcing their pluggable optics from a merchant chip competitor in 2027, that 87x valuation is going to become a very heavy anchor.
You are identifying the mechanical compression risk of this valuation. For this stock to continue working for investors, that $7.7 billion backlog must flawlessly convert into actual revenue.
Flawlessly.
Yes. If it does, the earnings, the E in the price-to-earnings ratio, will scale up dramatically. As the earnings grow, the multiple will naturally compress down from 87x to a more reasonable level, assuming the stock price doesn't just wildly outpace that earnings growth, of course.
Right. But it leaves zero margin for error.
Zero.
Oh.
Any miss on earnings, any supply chain hiccup on those pump lasers we talked about, or any delay in the industry's optical transition leaves the stock highly vulnerable to a multiple contraction.
So what does this all mean? At 87 times earnings, are investors looking at the current tangible reality of this company? Or are they exclusively buying into the sheer hype of the AI narrative?
Honestly, it is heavily weighted toward the narrative of future potential. Investors are buying the absolute certainty that this $50 billion total addressable market by 2029 is a lock, and that Ciena's coherent optics moat is deep enough to fend off the merchant chip threat.
They're pricing in a flawless 5-year future.
Exactly. The current fundamentals are exceptional, but the price tag reflects a belief that today's blowout quarter is just the floor for tomorrow's growth.
It is an incredible high-wire act. So to bring this all together for you listening, Ciena is, by every fundamental measure, executing flawlessly right now. We unpacked record revenue, earnings that quadrupled, expanding margins that defy the laws of hardware gravity, and massive co-created rollouts with the world's biggest tech companies.
The transformation from a telecom cyclical into the literal asphalt of the AI revolution is absolutely visible in the hard numbers.
It really is. The transition from copper to light in the data center is a physical necessity, and Ciena owns the noise-canceling technology making it happen.
But the counterbalance to all that operational excellence is the market reality. At $492 a share, the market has already given them full credit for this transformation. The future execution has to be perfect just to justify the present valuation.
Which leads to a final, slightly provocative thought I want to leave you with today. Throughout this deep dive, we've explored the massive physical demand for Ciena's hardware. The hyperscalers are in an arms race, pouring billions into these scale-across AI networks.
Yeah, the physical foundation is being laid at a breakneck pace.
But what happens if the software companies buying all this gear hit a wall and actually monetizing their AI models?
Oh, that's the ultimate blind spot of the infrastructure boom.
Right. If enterprise and consumer adoption of AI software doesn't generate the trillion-dollar profits everyone expects, does this ironclad $7.7 billion hardware backlog suddenly become a massive liability as tech giants pull the plug on their data center builds?
That would be brutal.
Or, on the flip side, has the world's physical data infrastructure simply been permanently elevated? Maybe this massive optical bandwidth becomes the new normal for global computing, completely, regardless of who wins or loses in the AI software profit wars.
It is a fascinating ripple effect to consider.
The AI software race cars might eventually stall out, but once the photonic asphalt is poured, it is there forever.
We want to thank you for joining us for this deep dive into Ciena. Keep questioning the narratives behind the numbers, look for the physical plumbing beneath the digital hype, and we will catch you on the next one.